Most traders don't understand consistently where to set their stop loss when entering trades, and it leads to bad habits, less winners, getting stopped out before moves, even when you're right on the market. And that inconsistency just starts to eat away at you. So what I want to do today is just run through how to set effective stop losses that make sense in context of higher time frame trade ideas. So we're going to start with AUDJPY and look at this 2R winner right here. And then we're going to look at a short bit of theory and some further examples on AUDUSD. So I'm just going to take this away and I'm going to bring up my higher time frame. So I'm looking at the 12-hour chart right here for my execution time frame, and then I'm going to overlay a higher time frame, and in this case look at the 2-weekly time frame. So we can see which pockets of external range liquidity are being raided to make sense of this price action. And what we see essentially is that price is breaking above this high. So any external range liquidity sitting here has been raided in this up move, this breakout. We've then retraced, tried to push higher, and sold off again. At this point, the manipulation candle right here closes. So the next logical path for price is to move from this area of external range liquidity to the lows. So we're looking for sell-offs. So with that said, we have a bearish price leg right here. So we can mark the internal range liquidity within this price leg. So if I just bring up the order block right here at the high and mark that as a 12-hour order block, because we're sitting on the 12-hour time frame. So we have the last buy before the sell, and then we also have the creation of fair value gaps. So right here is the first bearish fair value gap, because this is an imbalance between this down close candle and candle 3 right here. So we have context now. We have areas of internal range liquidity that we can trade from towards this external draw. But where do you first get into your trade? And more importantly, where do you set your stop loss to ensure you don't get stopped out before the move? Now, there's a couple of options, and I've got a separate video on how to enter trades, but let's just assume that we take a short from the fair value gap. So in order to set our stop loss, we need to think about which level would be safe for us to get involved without being stopped out. And the most obvious place is to mark the swing point. So the swing high of the price leg from the top of the bullish candle before the sell-off sits right there. So instead of trying to just cover fair value gaps or any other points of internal range liquidity, we can safely set our stop at the high, knowing that price may want to sting into the order block, but eventually will pull down to the external range liquidity. So that gives you to the low a 1.45 hour trade. However, there's reason to believe, looking at even higher time frames, that will sell off more aggressively. So this then turns into a very, very strong swing trade. If you have a fixed R target, you might want to get out at 2R, for example. So that's the logic, and even though we had to suffer a lot of drawdown here and nearly got stopped out of the trade, by placing our stop loss at an effective swing point, we were able to stay in, ensure that the drawdown didn't stop us out of the trade, and still actually hit a winner. So that's the theory of setting your stop loss in places that make sense, but there is more to it. So let's get into a very quick bit of theory. So what is stop loss placement? The definition is that systematic process of positioning your protective stop at a level that invalidates your trade idea while giving price room to move naturally. So in this example, this is exactly what we did. It's still natural for price to want to mitigate the order block right here. So it didn't make sense to have our stop loss at the top of the fair value gap, for example, because price might want to invalidate or mitigate the order block before selling off. Most traders place stops based on arbitrary rules. So this could be fixed pip target amounts, percentage of account, round numbers, and they just get stopped out in what is actually normal price movement within price legs before those price runs to their higher time frame target. Why does it matter? We want less stop outs because that means higher win rate and just better psychology. So we really have two options when setting our stop loss. We can A, cover the swing point. So when we're looking for example, continuations, we can mark the swing low right here. And when we're setting our stop loss, we can buy from internal range liquidity, cover the low, and then look for continuation. So that's option A. Option B is when price does this. We get a push higher, push lower, push higher, and then we eventually come back into the internal range liquidity in this price leg and trade higher. So what we could potentially look to do is trade from internal range liquidity, but only cover the liquidation because price has already swept the liquidity at this level. So there's no reason for price to want to return here because it's already done its job in sweeping this low. So it makes sense to only cover the areas of internal range liquidity in this area of the price leg. And still, if you buy from maybe fair value gaps or order blocks, you can start to refine your entry down to get much higher R multiples. So let's look at when that makes sense. So if I just head on to AUDUSD, we can look at the exact same thing happening right here. So we have price digging below a previous candle range right here, and then shifting bullish with this bullish aggression, the creation of this bullish price action. So we can again mark the internal range liquidity in this area. So you've got the order block, and then if we just mark the fair value gap right here, and this is a bullish fair value gap, then we can see where it makes sense to take trades. And the whole premise of this trade is to see price do this, trade in and then trade out towards the next pool of external range liquidity, manipulate it below, target the high, and even potentially these highs. So that's essentially what we're looking for. So where does it make sense to get into the trade? Well, again, the fair value gap makes sense. It's fairly high in the price leg. You might not want to expect to see price really retrace down into these levels. It just wants to sting in because it's aggressive and it's moving towards its higher time frame target. But at this point, you can see we've liquidated this low. So the option is we either cover the swing point, which sits right down here, the swing low, but then we have a 1.69R trade. Second option is that we just cover the liquidation of the candle range low. So price has stung in, shifted, we have internal range liquidity that needs to be filled, but we're not expecting price to dig right down into these levels. So instead of covering the order block in this case, or further mitigation of this fair value gap, we can just set our stop below the liquidation, and that turns into nearly a 4R trade. So you see the difference right there from a 1.69 to a potentially 4R trade. And that's how we can use refinement, by only covering liquidations before moves. The truth is, there is no one fixed rule. Sometimes price will mitigate the order block or even the swing point and still go higher. And that's where you need to look at things like risk management and just accept that you are not going to win every single trade. You may get stopped out of trades. But if you're consistent and you use either stops covering liquidations or stops covering swing points, you're going to win a lot more trades. And that's essentially how to use stop loss placement to get into trades and stay in trades, even when you're suffering drawdown, and hit more winners. So how do we actually apply this? So first and foremost, you need to establish your higher time frame trading targets. You need to understand what areas of external range liquidity are being raided or liquidated, and where is price heading next. Once you know that, you can decide where to enter within the price legs that take you to your target. You have two options. You cover the swing low, or you cover the liquidation of lows. And I'm going to create more videos looking at examples of this, because there are always nuances, but they're effectively the two areas that you want to cover with your stop loss to hit more winning trades. Trade only when there is enough risk reward potential. So if you only want to take trades that have at least a 2R or 3R risk to reward, then you need to factor that in. Maybe it is that you have a tighter stop loss, but you understand you might not win as many trades, or you only cover your swing point. However, you need to see a lot of room for price to move and still make sense to hit those higher time frame targets. So my model is that I track and analyze 32 Forex pairs. This includes gold, silver, Bitcoin, and I'm tracking 12-hour price action in conjunction with higher time frame ideas. So monthly, 2-weekly, weekly, sometimes even a 3-monthly candle. And I just execute. And once you get good at this, you can do it in 10 to 15 minutes a day. I have a lot more content like this, looking at specifically swing trading, and I'm going to create courses that look at the lower time frames. So if you're interested, subscribe, and I'll see you on the next one.